Hi. So in today's scenario, we see in the trading market, many traders are losing their money. They're getting losses more than 90%, 75%, 80% because it's a very high volatile market. So what all measures your trading company take to protect the customer's capital in the market?
Whether it is our trading department or any trader, there are three main measures which you can apply. Number one is to use stop loss in every single trade, and number two is to use stop on your account level. For example, let's say you have $10,000 and you want to stop trading at $5,000 after losing $5,000 in case all of your trades in the row are going in losses. And the last thing is to hedge. So I will go one by one and let you understand all the scenarios. So when we use stop loss in every single trade, many times what happens is the market goes making one spike hitting your stop loss. So unless you are very sure about any certain level, you shouldn't use stop loss, because there are always pros and cons of using stop loss. And this was the simplest way to protect your account or protect any single trade. However, this method started failing more frequently, which is why traders came up with another concept that they, rather than using stop loss, which our trading department is also doing, rather than using stop loss in a trade, they use stop on a account level. Now, when it comes to account level stop, then you can set some level, whatever is your risk appetite. I cannot suggest what is your risk appetite. It totally depends on a trader or investor, how much money someone is starting with. Many people simply start with the amount they can afford to lose, so they do not need to put any specific stop, because they are already putting only that particular amount which they are ready to lose, which they can afford to lose. On the other hand, some traders have a limited capital which they put in the account, but they want certain percent of that account on a certain strategy, or on a certain trader or fund manager. So they want some specific percent to lose, which they can set. And we have developed such kind of software which can close trades at any certain level. The second is to hedge, but hedging is slightly better in case you understand that the market may be ranging in a certain price levels. For example, if we'll look at the USD CAD, which has been recently ranging between 40 60 and 4120 since 21st July. But we need to understand what is the fundamental or economic reason because of this ranging market. If you do not understand and if you simply depend on the chart, then suddenly this range may be broken to either side and market can start trending, or a breakout can occur. So that's why if we understand the fundamental reason, for example, let's say you, USD CAD. So USD CAD is ranging because US US dollar is strengthening because its status as a safe haven. So whenever there is a probability of escalation in the US-Iran conflict, US dollar as well as oil increases. But on the other hand, Canada is also the one of the largest oil producer. So on certain time, Canadian dollar also gains because of increasing oil prices. So sometimes you can see some minor upswing and downswing swing in USD CAD. This ranging condition will sustain as long as this particular economic scenario will prevail in the market. The day economic scenario will change, the range which you can see on the chart will be broken. If you understand this ranging condition, you can hedge and you can take profits from trades of both direction. In that case, we also have developed a software which can partially hedge or fully hedge all the trades at any certain level. It can hedge all the trades of a symbol or all the trades of all the symbol which can be configured. So this is how we protect our account and we manage the risk. That's all in short. Thanks.